This is David Ranson. Welcome to HCWE's client webcast. It's based on data through the end of April 2022, and it's on the topic of persistent stagflation and Fed credibility. And it goes back to the beginning of our claim that we should be using empirical work and factual evidence historically to decide the major questions of economics today. And there are some very big questions that are coming up. Questions, I'm arguing, that history should be relied upon to answer.
So our purpose is to address some very basic questions that are not often addressed, because people think they know the answers to these questions. But it's pretty clear that the Fed is not at all sure what the answer is to the first question: to what extent do interest rates control inflation? If it did know, there would be a lot less uncertainty in its pronouncements and its actions. The second question is whether the Fed's rate hikes can cause a recession. Those who are familiar with our work know that we are very doubtful that interest rates do control inflation, and we are also doubtful that interest rate hikes today would cause a recession, even though it's quite certain that they did cause recessions in the past. The third question, what is the best leading indicator for US inflation? And then finally, how can inflation be stopped? So these questions go beyond a lot of the questions that we raise in our regular work. And here are some of the answers. The Fed is going to be pressured to raise interest rates far beyond current expectations, but rate hikes, no matter how aggressive, are not going to curb inflation. Fortunately, the Fed has also lost its power to create a recession in the foreseeable future. So the Fed's credibility, which is already at a low ebb, will continue to fall. And there's going to be a struggle to identify more radical policies to bring inflation under control. Initially, we'll look to the Fed to identify these radical policies, but over time, I think we'll look outside the Fed. Implications for capital markets and the economy are that inflation is still accelerating. The talk of inflation coming down is based on the recent estimates and release for the Consumer Price Index and other indexes a day or so ago on May the 11th. But there was also a very large, an unusually large drop in the price of crude oil and energy prices generally. So it looked, I think, the inflation picture looked better than it really was. The price of crude oil has always been a wild card. US GDP has settled down to very low real growth, but the risk of recession is low and the economy will be stable. And this is a stagflation climate that favors real assets rather than equities. Treasuries will produce negative returns, but low-grade bonds, the lowest grade bonds, will produce positive returns. They are boosted by inflation. Now, I want to show evidence from history addressing these very major questions. How effective are Fed interest rate hikes in controlling inflation? What does history tell us? Well, you'll see in the subtitle to this slide, I'm looking at the seven most dramatic shifts toward tightening interest rate policy. In other words, the seven largest increases in short rates. And on the average, we find that the CPI inflation rate accelerates by 1.4 percentage points when one of these hikes takes place. So we look for a delayed effect. But after 2 years, the cumulative rise in the CPI inflation rate is 1.7, higher, and it remains around 1.7 for another 2 more years and even slightly rises after yet another year. So over a 5-year period, there's actually no sign at all of any reduction in the inflation rate historically, looking at the most dramatic Fed tightening episodes. That's pretty strong evidence against the myth that the Fed has this tremendous power in its toolbox. Now, the Fed is also trying to modify or moderate inflationary expectations. If the Fed were successful in curbing the inflation rate, it should also be able to bring long-term interest rates down. So we can look at bond yields to see, over again a 5-year period, whether these periods of rate hikes are associated with a reduction in bond yields. And you see in the top line of this table, these are the 4 years in which the Fed raised rates by the most amount, an average of 328 basis points. And you see in the same year, bond yields went up. And in the following year, they went up again. And even over a 5-year period, cumulatively, they're still up. I include 2 more lines in the table to show that this is not just a relationship between Fed rate hikes and recessions, Fed rate hikes and inflation. It's also it should also be a relationship between Fed rate cuts and disinflation. So we show that side of it too, and we get the same. It's like a mirror image of the same data. The same results apply. When the Fed lowers interest rates, it does not raise it does not raise inflationary expectations at all. How about the Fed's power to cause recessions? Well, that undoubtedly did exist in the past. This is a table looking at the period from 1955 to 2001. And you see I've again divided Fed policy into scenarios, years in which the Fed raised rates by more than 300 basis points. There are 3 such years. And you see that in the first line of the table, we in fact did get recessions. In fact, all of those 3 occasions did produce recessions, and you see the average of minus 0.9 in the middle column. In the right column, you see that there's some recovery after of course, the recessions don't last forever, but growth is still, even 2 years after the Fed has raised rates, the economy is still subpar. However, if we bring this up to date, we get a different story. I've divided here the history from 1955 to the present into 2 30-year periods, roughly 30 years each, 32 years. And on the left, we see the early part of this period, the first 32 years, and you see a strong relationship between the extent to which the Fed changed the Fed funds rate, shown at the bottom there, and the average growth rate of the economy over a subsequent 2-year period. Strong relationship, plenty of evidence for the Fed's ability to slow the economy down. But then we take another 30 years, 30 or 32 years after that period, and we get completely a different answer. There's no sign here that the Fed is slowing the economy down, very little sign of any difference, really. These are minor differences in the heights of these 4 bars. And it's clear that the Fed's power to influence the growth of the economy has changed from the 1950s, 60s, 70s, 80s to the 90s, 2000s, 2000s, and teens. So this is the basis on which I think history shows, or I conclude, that we're not going to have a recession as a result of Fed policy, even if the Fed takes a much more extreme rate hike policy than it has really countenanced up to this point. Well, if Fed rate hikes are not the sign of recession that we need to look for, what is? And the answer is credit spreads. A different part of the fixed income markets do give strong signals of a change in economic growth when it's going to happen, including recessions. And you see here a history going back to the 1920s. And in this case, there is no reduction in the power of the credit spreads to anticipate change in growth. It's the same. If you test this statistically, you find there's no difference between what was going on in the 1920s and 30s and what is going on today. Credit spreads play the same role that they've always played. So they are a very reliable early warning of a recession. And if we're going to have a recession, clearly we have to have a big widening of spreads. Now, this is a picture of what spreads have been on a monthly basis since 2015. And we see that 2015-16, which was a slowing down of the economy during the Obama period, was accompanied by an elevation of credit spreads, but not a very substantial one, and it didn't last long. Another much more, really a tremendous widening of spreads occurred in 2020, right at the time that the economy collapsed in connection with the pandemic. And you see, well, this gives us a very good idea of how far spreads have to widen to produce a given amount of decline in the economy. I'm using here, as you see in the labels, the percentage by which the BAA yield exceeds the AAA yield. These are the two yields which are used typically by economists in business cycle analysis. But normally the AAA yield is subtracted from the BAA yield, and the difference is the indicator that is watched. That's because it's much more convenient to subtract than it is in mental arithmetic to divide. But it does turn out that dividing one by the other gives a more accurate estimate or a more accurate forecast of what the economy is going to do. And so I'm using the ratio here, or the percentage. The simple basis point spreads are still in widespread use, and I therefore include them in the graph as these little numbers attached to the data points. But the actual data points plotted are the ratio. And you see the spike associated with the pandemic also did not last long, and things were back to normal fairly early in 2021. And we can certainly see for the last year or so, spreads have been, although they've fluctuated slightly, they've been at what you might call a normal tight level. In other words, a level that suggests nothing is going wrong to reduce economic growth, at least on the monetary or financial front. And indeed, the growth rate of real GDP, which can be plotted monthly too on this graph, it looks like a mirror image of the spreads graph. A very sharp spike in spreads corresponding to a very sharp, a pit really in real GDP. And the path that the real GDP follows thereafter is one in which you have enormous growth to begin with, the fastest growth that we've ever seen, something like 22% at an annual rate in the second quarter of 2020, but declining. And I believe the decline has taken place according to a formula, really. The economy is trying to behave in a very systematic way. And of course, it's not exactly fitted, but I've shown in the dotted line, the curve, how the economy seems to have been trying to behave and how it has slowed down its growth rate to the point now where there's almost no growth left. In fact, there hasn't been any growth at all in the last 2 or 3 months.